All of this talk about the 50-year mortgage got me wondering, where did the 30-year mortgage come from? When was that put in place and why? What were the factors that made that happen? So, of course, I went down a rabbit hole and I thought maybe we needed a history lesson. So let's go back in time a little bit. So back in the early 1900s, mortgages were basically a trap disguised as a loan. So you got 3 to 5 years where you paid interest only. And then at the end, you had this balloon payment where your entire principal would be due. Of course, the common person could not do that. And then guess what? The bank took the house back. So this was a system built for banks and not buyers. So then came 1929, the Great Depression. Stock market crashed, banks failed, refinancing became impossible. Nearly half of all mortgages during that time defaulted. The entire housing system collapsed. So, as in many aspects, this is when the government stepped in and said, okay, we're going to rebuild this from scratch. So in 1933, the HOLC refinanced people into longer-term, fully amortized loans. So those monthly payments that used to be interest only now had principal in them. Shocking. In 1934, the FHA was created and introduced fixed-rate amortized mortgages that look more like our versions of the 15 and 30-year loans. Therefore, down payments dropped and lending got safer. Now, the third factor, in 1938, Fannie Mae was born. Fannie Mae stepped in and bought loans that created liquidity so lenders could actually keep lending. These three moves completely changed access to homeownership. And technically, the 30-year fixed loan started in 1934, but it didn't go mainstream until the 1950s. And that's when suburbs exploded. Income started to rise. And of course, more families wanted predictable payments, which makes total sense. Lenders realized that longer terms made homes more affordable for many more people. So it's really in that 1950s time span that the 30-year mortgage became more of an American staple in real estate. Now let's look at this chart because I think it's important to look at the mortgage rates from a historical perspective. So this chart goes all the way back to 1972. And here's the key takeaways. The historical average from 1972 to 1923 is 7.72%, higher than today's rate, because the 80s were a wild time in interest rates. The historical average from 1990 to 1923 is about 6%, not far off from where we are today. So historically speaking, rates in the sixes are not that high. It's just that when we have memories of rates between 2 and 4% in the pandemic era, it makes us feel that way. But historically, that's not exactly true. In fact, the only abnormal years are really in 2020 and 2021, which I would like to call the unicorn rates, because we had rates even in the 2% range. And then there's the worst of the times for rates, when in the 80s, rates were in the 16 to 18% range. So while we got to live in a time of unicorn rates, our parents who were purchasing homes in the 80s were literally fighting financial dragons. But they still bought. And wouldn't you want that house that they bought in the 80s right now today? So here's the takeaway. When affordability gets tight, people start looking for creative solutions. A longer-term loan lowers that monthly payment, which sounds great until you look at the math. So check out this second chart. It shows how much principal you would pay down over 20 years with a 30-year mortgage versus a 50-year mortgage. With the 30-year mortgage, you've paid about $184,000 towards the principal. But with a 50-year mortgage, you have only paid about $46,000 towards that principal. And the savings is really only about $200 a month. That's not a small difference. That is a totally different financial life. The 50-year mortgage can really slow down equity building. So yes, it would lower the monthly payment. And yes, it might help people qualify, but it would also keep people in debt longer and dramatically slow their wealth building. And I don't know about you, but I would rather my money go towards principal rather than interest. Other countries like Japan have tried ultra-long mortgages, but the United States only changes the mortgage structure when there is something financially wrong. So we might want to ask ourselves, why is talk of a 50-year mortgage coming up? If you want clarity around what's happening in the market and how your loan structure can affect you, or what smart decisions look like in this cycle, reach out. You deserve real information and not fear-based headlines.